Hey everybody, and welcome back to H Invests. So today I thought we'd look at Phillip Morris. I've covered tobacco companies on my YouTube channel in the past, and there's been about a 10% pullback on Phillip Morris shares after quite a long rally. So I thought we'd have a look at the valuation, see if the shares are looking good. We're going to look at multiple ways to value the company. We're also going to see what some of the analysts think and determine whether Phillip Morris is a good deal at current prices. I hope you guys enjoy the video. Okay, so this massive spreadsheet you can see here is my discounted cash flow valuation. So quick overview of the page. We've got kind of like past turnover and future turnover, past free cash flow, future free cash flow growth on the top left. We've got WACC here. We've got like a matrix kind of showing different outcomes of free cash flow and discount rate. And then we've also got like average turnover and free cash flow growth over here. So the first thing to look at is the past turnover growth, and you can see that that has been relatively low, and it's been slowing as well up until a point where they actually shrunk in turnover last year by 3.7%. The analysts are optimistic on turnover though. They see a massive rebound in 2021 and then some pretty consistent growth after that. If you average that out, you're getting between 5 and 6%, depending on whether you use a compounded average growth rate calculation or whether you just average out these percentage growth figures. It's always important to do both, because then you can see whether it's coming from like some unusual year where they grow massively, or the compound average annual growth rate will give you a kind of more smoothed out return of what the turnover is growing. So that's important to look at. And it might be a bit strange them growing at such fast turnover after like such a slump. And I would be a bit more skeptical of this if they hadn't really managed to grow their free cash flow at such a good rate going forward. So basically what this is saying, what we can infer from looking at these growth rates is, in the past, because this free cash flow was growing at 7 and the turnover was basically growing at 2, Phillip Morris's free cash flow growth came from improving margins rather than improving sales growth or cigarettes, or at least improving margins was a much bigger driver of their growth. But now going forward, it looks like what the analysts are saying is that the margins are going to be flat, but the turnover is going to be the main driver of growth, right? So that's a really, really interesting thing to see. If we put these free cash flow numbers in, that's what we've got here. And they were actually like, there was a relatively narrow range. Like the analysts seemed to be quite confident on these free cash flow numbers. There wasn't a big divergence in estimates. And that's really, really good. But I wouldn't expect there to be with a company like Phillip Morris, which is inherently very stable because it sells cigarettes, right? It's a very non-cyclical product, and they've got a very, very wide economic moat for a multitude of reasons. So the weighted average cost of capital, I don't like to put too much emphasis on this, but I like to do the calculation nonetheless. And that came out at 7%. So we'll use that for the base DCF, and then we can always change it afterwards. So at 7% discount rate, with these free cash flow numbers from the analysts, taking into account, net borrowing that Phillip Morris has and the number of shares, we're getting an intrinsic value of $114 per share, which at the current market price of $94.38, that gives us 21% upside, which is okay. It's okay. For a company that is relatively stable, 21% upside is okay. We would ideally like a wider margin of safety, but 20% is a better margin of safety than nothing. Let's say that. So that's our base case, if you will. What we can see here is we can see the free cash flow growth in a matrix, looking at different growth rates at different discount rates. What I did was I put in a bear case, a fair case, and then a bull case as well, to kind of put in different scenarios. So because the analysts are very confident that the free cash flow is going to grow at about 6%, we're going to use that as our fair case, put it down to 4 for the bear case if they miss those free cash flow estimates, and then the bull case of 8% is then beating it by a significant amount. And again, like what we can see, I chose between 7 and 8% discount rate. You can see at 9% discount rate, the shares are pretty much overvalued on all growth rates, and then at 8% they're fairly valued, which is quite interesting. But I wouldn't warrant a 9% discount rate for a tobacco company. As I said, they're non-cyclical, wide economic moats. Their consumers are addicted to the cigarettes, and it's not really something that warrants a discount rate that is almost the same as the market. So I chose between 7 and 8% because at the same time, like, there are risks to this company. Like 7% is quite low, particularly with all these regulatory risks that the tobacco companies are facing. However, Phillip Morris, they're an international company. They operate everywhere apart from the US. And because there's that diversity geographically of their revenue, and then there's kind of less regulatory risk than something like Ultra that's 100% US. So maybe Phillip Morris deserves a slightly lower discount rate anyway. But anyway, so if you look at between 7 and 8% discount rate, and if you average out all these scenarios in the box, bear case, fair case, and bull case at 7 to 8%, you get a fair value of $116, which is very, very similar to what the base DCF forecasted up here. So that's looking relatively positive. What I wanted to look at now is earnings per share forecasts. So what we're doing here is we're basically getting the earnings per share, and then we're multiplying it by projected price to earnings ratio to give us our target price. I also discount these forecasted earnings per share numbers, which is very, very important to do because $1 today isn't worth $1 tomorrow. However, the discount factor has much less of an influence over this valuation, which is nice because you see in discounted cash flows how sensitive the discount rate is to the intrinsic value, and here you can put in a discount rate which will affect it. Believe me, it will affect it. I'll show you that in a minute, but it won't affect it as much as a DCF. So for example, if we didn't put any discount rate in here, we would get 130 as opposed to 104. I put in 7.5 as a kind of a case. As I stated in my last slide, that's kind of where I think my discount rate should be for these kind of companies. If we said, okay, there's going to be more regulatory risk in the tobacco companies going forward, and we go from 7.5 to 8, it only changed it from 104 to 103. So it's not a big factor. The much bigger factors in this is the price to earnings ratio, and then obviously the earnings per share. Those are the two that you're multiplying together to get the share price. So you can see, again, Analyst very bullish next year. There's going to be a big recovery for Phillip Morris, really, really big. And yeah, when you average these out, I actually haven't got that figure down, but what are you looking at? Probably 7, 8, maybe 8%, I would say, average growth. So slightly higher than what we saw projected in free cash flow growth. The other thing we've got here is we've got the normalized PE. So we're looking at the price to earnings across Phillip Morris's time span in the last few years, seeing what the market price it at. And at the moment it's trading at 18.3 PE, which is quite high for a tobacco company. It really, really is. And then if we average these out, it gives us an 18.5 PE. So when you multiply that by the earnings per share forecast, we're getting an intrinsic valuation of just under $105, which is again pretty good, 11% upside. So I'm very, very happy with that. The only downside I would say to this is that PE is quite high given the 6% growth that the market is forecasting. That's all. That would be my only concern, because compared to other tobacco companies, which are also growing, this PE is very, very high. And to use this high PE and not get a large margin of safety out of it doesn't give me the highest level of confidence on this. I feel much better with what we got from a discounted cash flow valuation. If we change this PE to 16, just to give you an idea of how this is going to vary, we then get it's overvalued, and the fair value would then be 90. So if the market decides, oh, we're going to value Phillip Morris at 16 times earnings compared to 18 times earnings, all of a sudden these shares don't look too good. So that would be one thing, is that, like, I get that the market has averaged, its average PE over the past 5 years has been about 18.5. This is a downward trend though, as we can see here. Like, it doesn't trade at such a high multiple as it was a few years ago. A lot of that's to do with ESG reasons, I know. So if the market does want to price Phillip Morris lower, this is going to impact that valuation quite a lot. One positive though is that you can see here, this data is from Seeking Alpha, the range of EPS estimates is quite tight. So if we look at next year, we've got 608, but we've got a high of 619, and we've got a low of 603. So that's quite, for a sample of 17 analysts, That's quite a low range, which is really, really good, because then that means we can use these earnings per share estimates with much more confidence. The last thing we're going to have a look at is the analyst forecast. I picked out some analysts that have recently kind of looked at Phillip Morris, and some of them have changed their price targets to just kind of see where we were kind of at with it. And a lot of them have ballpark figures very similar to what we had in our valuation. So Morningstar 108, that's kind of very similar to what our metrics are coming out as. Thomson Reuters, which is an average of analysts, and Seeking Alpha, which is an average of analysts as well. They're looking at 18% upside on the current share price of 94. So that's not bad at all, really. I do take these like analyst estimates with a pinch of salt. They're not a big factor in my decision making, but it is really, really interesting just to see what the analysts are thinking and how that differs from the current share price. If most analysts are like they give it more than 20% upside, that's often something to pay attention to, but most of the time, like, analysts are slightly bullish on a stock anyway, because they like to sell their research and say, oh, XYZ is a buy. So yeah, I'm taking all of this with a pinch of salt, but it's very interesting to look at nonetheless. So what are my initial thoughts on Phillip Morris having done a valuation? So, I mean, it looks good on the DCF perspective. 21% upside for such a defensive company is pretty good. The earnings per share didn't give us such a margin of safety. I think one thing with Phillip Morris as well is that they have a really, really high dividend payout ratio compared to their yields. Because a lot of these tobacco companies aren't growing extraordinarily, and the main part of their business, selling cigarettes, is in secular decline, a lot of people are drawn to them for income. They're income investors that are drawn to these stocks. And when you've got Altria at nearly 8%, British American Tobacco at 8%, Imperial Brands at nearly 9%, but British American Tobacco and Altria have much lower payout ratios than Phillip Morris. I think Phillip Morris's dividend payout ratio reached 100 and went over 100 once or twice in the past few years. So, but the yield is lower. The yield is 5% on the nose. So from that standpoint, it doesn't look like as an attractive investment, but they might be able to grow their dividend much quicker if they're growing their earnings per share quicker. So that would be one positive. I think what I'm going to do, because I already own shares in British American Tobacco and Altria, given that this margin of safety isn't incredibly high, it's going to take a lot for me to invest in them because I already have exposure to tobacco. But what I think I'm going to do is make a video next week comparing all the tobacco companies and actually saying which one looks like a good deal when you stack them up side by side. So let me know if that's something that you're interested in. I hope you found my valuation of Phillip Morris useful. Let me know in the comments if you've got any questions, and I look forward to seeing you in my next video.